Hey, folks, welcome back. We are getting closer and closer to the end. That's not meant as a threat. It just is, things are moving. And especially after this week, the third quiz, the final, the project, all will start piling up. And the item that will get left behind because it's not immediate is the project. So in a sense, if you have time, get some work done on the project. The bulk of the work is getting the cost of capital for your company started. So at least you can do the rest of the work. So if you've been putting it off, this is the week to catch up. So last week we were talking about the trade-off between debt and equity. I listed the two biggest advantages: the tax benefit of debt, coming from the fact that interest expenses are tax deductible. And the second is the added discipline that comes from borrowing money. If you're a company with lazy managers, splintered equity investors, sometimes debt can make managers more disciplined. On the other side of the equation, we started with bankruptcy cost, expected bankruptcy cost, function of how volatile your earnings are, because that affects the likelihood of bankruptcy, and the cost of bankruptcy. And remember, that includes both direct and indirect costs. The indirect costs come from the perception if you're in trouble, you get into trouble. And then we talked about agency costs. Again, in economics, there is this famous principal agent problem. It's at the core of so many research papers, theory papers. But it's a very simple concept, which is if you ask somebody else to do something for you, they will never do it exactly the way you'd have done it. Now, over the last 4 days, my grandchildren were here visiting me, and my grandson got sick. So I told his mother to leave my grandson with me for the night because I told her I'd look after him. And she did. But all through the night, I'd keep getting text messages saying, "Are you checking his temperature right now?" Who's the principal? Who's the agent here? The mother is the principal. I'm the agent, and she's worried that I would not do things exact. And it's perfectly understandable. In the context of debt and equity, though, think of principal agent problems. Who's the principal and who's the agent in the debt equity trade-off? You got a 50-50 shot. Go for it. Who's worried and who's creating the worries? The lender's worried. So lender is the principal because he's or she has lent the money out. And the equity investor is the agent because they now have your money as the lender and you're worried about what they will do for it. So when you think about principal agent problems, I want you to think like a lender. Think about what worries you because that's what's going to create the cost for the borrower because now you're going to try to take care of the worry. So I'm going to show you 3 different companies that you could lend to. And I want you to think about which of these companies is going to give you the most worries in terms of keeping you awake at night saying, what the heck are they doing with my money? The first is a technology company, and you can be a software company, but it's some kind of a technology company. The second is a large regulated electric utility. In the US, they're monopolies, they're regulated by the government. And the third is a real estate company. In which of these 3 will you sleep the best? And why? And then tell me why. Because somebody else is keeping an eye on them. They're a government. You can't go into new businesses. They have a business that's non-discretionary. Now do you see why power companies can borrow a lot of money and not face a lot of covenants? You don't need them. Which then brings us to which one's going to keep you awake the most at night. And you have 2 choices: the technology company or the real estate company. I'm kind of mixed on this, but think like a lender and think about which one worries you more. And what is it about the technology company that worries you?
In comparison, real estate, at least there's an underlying asset.
You can see. It's not that there's an underlying asset in both cases. In one case, it's tangible, you can see it. And if you cover it with gold, it's even more visible. I've never understood why bankers lend so much in real estate, to be quite honest. But I understand the psychology, which is you drive around the building saying, that is the building, my loan. Whereas if a software company or a pharmaceutical company says they're borrowing your money to do R&D, how do you really know? They might be hiring people off the street, putting white coats on them, say, walk around this glass building looking busy. And you're sitting there saying, they must be doing a lot of research in there. Yesterday, I saw Jensen Huang on CNBC showing this little thing. This is the microchip of the future. Do you really know? I mean, he could be holding up something he bought at a sidewalk stand and saying, this is the, and you'd be saying, oh my God, that is amazing. Agency problems, for better or worse, tend to be worse at companies where you can't see what you buy. So you know what this means, right? So if you're lending to a technology or a pharmaceutical company, you're going to be more worried. So what are you going to do to alleviate that worry? Charge a higher interest rate or hire a huge number of monitors, neither of which the pharmaceutical company likes or the technology company likes. So guess what they end up doing? They don't borrow very much money, even though they have the capacity to borrow money. So for those of you analyzing a Merck, a Pfizer, a Microsoft, you say, why don't they borrow more money? Because you look at their debt ratio. It's 4%, 5%, 6%. One reason is if they borrowed more money, the kind of monitoring and constraints that would come with it would be so onerous that they couldn't do a thing. Yes?
Real estate company the same dollar value.
No, it's not even, so never lend on assets. Because how do you pay interest? What do you need for interest payments? You need cash. If you lend based on liquidation value, you've already lost the game. Though bankers do it around the world. What is the value of your assets? It's a silly way to lend, right? Because ultimately you got to be paid in cash. So if you have two companies with the same level of cash flows, that's a comparison. The company with tangible assets will be able to borrow more than the company with intangible assets because the lending will come with fewer strings attached to it. And those strings cost you as a company because that means you can't take projects you otherwise would have wanted to. So that's the agency costs. Agency costs show up as these long covenants. They show up as higher interest rates, restrictions on what you can do. Yes.
So is that saying that if you had technology in a real estate firm and they had like the same data, which wouldn't happen?
Yeah, let's say they do.
Say they do. That means the lender is like still going to put a premium on the technology firm, even if
lenders don't pay premiums, right? They don't pay. They don't buy the stock. The only thing a lender sets is the interest rate. You're not going to be able to borrow it below market rates if you're NVIDIA. Because frankly, the upside of NVIDIA doesn't help me as a banker, right? Remember, upside has zero relevance for me as a lender. It's all about downside. That's why we can't use betas to get a cost of debt. Beta is designed for both upside and downside. But with lending, only thing you care about is what is the chance I will not get paid.
So at the start of what you said for us to think about the position of the lender, you want us to do that because as the borrower, you are subject.
Exactly. Because the lender worries, you basically will pay the freight. You will pay for it because the lender is not going to stay in bed worried and let you borrow at a low rate. You ultimately bear that cost. Beta is irrelevant because that's an equity issue. The equity investors who invest in a company invest based on upside. The lender doesn't care about it. Which brings me to the last piece of the puzzle. So, and this is a smaller issue, which is when you borrow money today, you give up that capacity to borrow the same money. And this is true for businesses and individuals, right? If you have debt capacity and you go out and take it on today, what if 6 months from now you face an emergency? So let's follow up on that. For companies with unpredictable investment needs in the future, you want to preserve debt capacity even though you have it. For companies with predictable investment needs, we know what's coming, you're more likely to borrow up to the hilt. Again, you can see why regulated utilities can borrow up to the hilt. They've made their plans for the next 10 years and what plans to build and what equipment to make because there is no unpredictability in this business. In contrast, when you look at a technology company, you could be the greatest technology company in the face of the earth, but you have no idea what next year is bringing. The more uncertain you feel about the future, the less you should borrow money. And let's make a macro statement about this. If you look at collectively, if you look at businesses today versus 40 years ago, do businesses face more uncertainty collectively now than 40 years ago? Tell me some of the reasons. I mean, they're probably the hot button issues of the world today, right? Globalization. How does it create more uncertainty? If you live in a local market where outsiders can't come in, you feel more protected than when others can come in and take away your market share. Globalization. Disruption, the fact that newcomers can come. It used to take decades for newcomers to get established. The reason DeLorean never disrupted the automobile business, it took them so long that the other automobile companies were able to kill them off. Tesla in a decade disrupted the whole business. Amazon in a decade destroyed the brick and mortar retail business, huge businesses. Globalization, disruption. So what does it mean? Collectively, companies now should be borrowing less money than 40 years ago. Are they? Remember, a lot of debt decisions are driven by inertia and what we used to do. So when you think about the trade-off, those are the things that go in. Now, of course, the question always asked in corporate finance is, we know what should drive decisions, but what do people actually look at? Because there are behavioral forces, inertia. So this is from a survey of CFOs where they were asked, what is your primary factor in determining how much to borrow and whether to borrow? Number one was maintain financial flexibility. Okay. Right below that, long-term survival, predictable source of funds. And at the very bottom of the group, they claim that they wanted to be close to peer group. I think they're lying because when you look at the facts, it suggests otherwise. But it sounds like you shouldn't be saying that as a CFO, but no. For better or worse, these are the survey results. We'll come back and talk about that. But essentially, let me summarize the trade-off from last session in this. On the left side, you got, on the plus side, you got tax benefits of debt, which should be higher, the higher your marginal tax rate, which can change over time. In 2026, we might be facing a very different marginal tax rate in the US. Added discipline, which is a function of, hey, how much do I worry about managers taking bad projects? Should be greater at companies with splintered shareholders where managers are not accountable. On the other side, expected bankruptcy costs, greater at companies with volatile earnings because the probability of bankruptcy is higher, and companies that make products and services where people worry about whether they'll be around. So less in grocery stores, more in aircraft companies. Agency costs, which are greater in companies with intangible assets where it's difficult for lenders to feel secure about the lending. And finally, the loss of flexibility, which will be greater at companies which are uncertain about the future. We've got the ingredients that will help us determine whether our companies, even if we can't get a number, whether our companies should be borrowing a lot of money, not that much money, or no money at all. I know it doesn't give you a specific answer, but let's start the process with that. So I took my 4 companies. Again, I'm going to keep Deutsche Bank completely out of the mix. Why? Because even talking about the trade-off between debt and equity makes no sense at a bank. Debt to a bank is raw material, and I've said that before. It's not a source of capital. So there is no optimal debt ratio for a bank. There's too little equity at a bank because you can hit regulatory thresholds. But among the companies where I can make the trade-off, here's what the numbers look like. On the tax benefit, this is 2013. Disney won hands down, had the biggest tax benefit because that time the marginal tax rate in the US was 40%. The Brazilian tax rate was 34, 25%. So if I just based it purely on tax rates, Disney should have the most debt. File that away. In terms of added discipline, in every company other than Disney, there were other people looking over the manager's shoulders. Disney, at that time at least, had splintered shareholders. There was no Nelson Peltz. If I were doing this today, the fact that Nelson Peltz is there, at least for the moment, means there's somebody prodding Disney. Right? In terms, so that'd be, if, in terms of expected bankruptcy costs, remember it comes from two places: how volatile are earnings, Baidu, young firm then in technology, Tata Motors, cyclical company, and Vale, commodity prices, all of which can cause earnings to change dramatically year to year, even though you might be a mature company. Disney perhaps has the most going for it because it's in multiple entertainment businesses. Theme park can offset. Now remember, this was before Disney streaming created a huge volatility, more predictable earnings. So if you think about indirect bankruptcy costs, I would expect it to be greatest in an automobile company. I would not want to buy a car from a company that's triple C rated. What the heck am I going to do trying to get replacement parts 5 years from now? I'll walk into a Disney theme park, even if it's maybe not triple C rated, things might start falling on my head, but maybe triple B rated, double B rated, maybe there's a threshold at which you'll stop going. But I'll walk into an Avengers movie, even if it's made by a triple C rated company, as long as it's entertaining. You can see why indirect bankruptcy costs vary. In terms of agency costs, I'd probably be terrified lending to Baidu. I don't even know what research on a search engine involves. But when I lend to Vale and better or worse Tata Motors, I get physical assets. With Disney, depending on what I'm lending to a theme park, I can see what I get. Lending on movies, I don't feel as comfortable. I would expect the debt to vary across Disney depending on the business. And finally, in terms of flexibility, Baidu was the youngest company in 2013 when I looked at it. Should probably value flexibility the most. So you can see that with each of these companies, you can actually do that trade-off and at least make a judgment, a preliminary judgment of should my company be borrowing money. I'd like you to try this on your company. It doesn't require rocket science, just requires a basic understanding of your company. The tax rate is an easy one. Look at the marginal tax rate of the country you're in. The added discipline question is going to be tied back. You're going to notice that as you go through, previous sections come into play. That corporate governance section, we asked, how much do I worry about the manager, is going to play into the added discipline. The expected bankruptcy costs, you can look at volatility of earnings. Don't let the words drive you. Basically look at the numbers, right? If the earnings go up and down over time, they're volatile. And you can also look at what kinds of products. Put yourself in the shoes of somebody who's buying that company's product and ask, will I care? And finally, look at how uncertain your company is about the future. The more uncertainty, the less they should borrow. And at least make that early judgment on, is this the kind of company I would expect to borrow money? Yes.
If your company is controlled by a single founder, right? Then is it actually relevant?
See, there are two kinds of agency prompts. There are three agency prompts. First is managers versus shareholders, right? That's one agency prompt. Inside shareholders versus outside shareholders, a different kind of agency prompt. Lenders versus equity investors, a third kind of agency prompt. You're talking about the insider outsider shareholder. Is it possible you could have a company where outsiders would like the company to borrow money, but insiders don't? Yes. But there, it's not the discipline that you'd want to use to get them to borrow money. It's that you think there are tax benefits left on the table. So if Facebook is not borrowing enough money because Mark Zuckerberg does not want to borrow money, if you want to put pressure on him, it's not because he's taking bad projects. It's because you want him to take advantage of those tax benefits that are being left on the table. Have you ever seen a Twilight Zone episode? One of my favorite shows of all time. I watch the old episodes over and over again, especially late at night. Okay. I'm going to put you in a Twilight Zone episode. You might already be there, and if you are, I'll join you. And here's what you wake up to in this world. You're now in a world with no taxes. That reminds me, I actually have to file my taxes today, so maybe I'll wake up tomorrow in a world with no taxes. No managers in this world have shareholder interests front and center. They care about shareholders. They do the right thing. No firm in this world ever goes bankrupt. It's not an exciting Twilight Zone episode, but stay in there anyway. Equity investors are honest with lenders. They go in and tell them exactly what they're going to do with your money. And every firm knows its future financing needs with a fair amount of certainty. Ready? You're in this world now. Let's do the debt equity trade-off. What's the tax benefit of debt in this world? Zero, right? What about added discipline? You don't need it. Managers already do the right thing. Expected bankruptcy costs? Not there. Nobody goes bankrupt. Financial flexibility? Who needs it? You know your future with certainty. And equity investors never lie, so you don't have any agency problems. So you have zero benefits, zero costs. In this world, how much should a company borrow? Let me rephrase the question. When a company borrows $100, what does it get as benefits and what are its costs? Zero. 100 million, zero. Billion, zero. So how much should a company borrow? It doesn't matter. Congratulations, you've just derived corporate finance's most famous theorem. It's called the Miller Modigliani theorem. In the Miller Modigliani theorem, in a world with no taxes, no default risk, and no agency problems, it does not matter how much you borrow. You know what the consequences of this are? If you change your debt ratio as a company, your cost of capital will stay fixed. Why? Because there's no benefit to borrowing, no cost to borrowing. So you're just replacing equity with debt. Effectively, the firm is the firm. The value of the firm will not be a function of how much the debt ratio is. It's an incredibly convenient word because you don't have to worry about the financing problem. But is it built on unrealistic assumptions? We live in a world with taxes and with default risk. Saying, what's the point? Merton, Miller, and Franco Modigliani won the Nobel Prize not for showing that debt doesn't matter, but for setting up the structure for thinking about when does debt matter. Because you could take this theorem and you could create it in second Twilight. The people liked the first one so much. The ratings were so high, you're allowed to create a second episode. In the second episode, the only thing you change is you now live in a world with taxes, but everything else stays the same. No default risk, no agency problems. How much should you borrow in that world? 100%, right? Because I've given you the benefits of debt, no costs. You could put a third episode where you take the tax benefits out again, put in just default risk. How much should you borrow? Nothing. You've essentially laid the foundations for how we think about debt and equity today. That's the 1958 paper from which corporate finance was born. You'd be amazed at how many people, though, still hold on to the Miller Modigliani theorem as the truth. I talked to an LBO guy the other day. I said, guys, I'm borrowing way too much money. And he said, doesn't matter. In fact, one of my most famous run-ins was with somebody who went through my very first class in 1986, joined an LBO outfit that actually financed the LBO of Federated, or with the company that used to own Bloomingdale's. One of the most ill-fated LBOs of all time, falls apart. The firm that took the company private, took Federated private, actually went bankrupt. This guy lost his job, found another job. And I ran into him on Wall Street and I said, what are you doing? And he said, I used to work for the firm. I took Federated. And I said, I never understood that LBO. Why would you take a high-end department store like Federated and load it up with a lot of debt? And he said, don't you remember Miller Modigliani? And I said, I do. And I'm glad you live in a world with no taxes and no default risk. But can you remind me what happened on your last job? Without a trace of irony, he said they went bankrupt. You see the irony here? You're talking about Miller Modigliani and the company you used to work for went bankrupt. That is definitely not the Miller Modigliani world. But you know why people like to use Miller Modigliani? Because they can avoid the talk of, have I borrowed too much money? That's basically it. It becomes like garlic with a vampire, right? You talk about it, no, Miller Modigliani, back off, right? So that you don't bring up the issue of, you can't afford to borrow this money. So let's be real. In the world that you and I live in, there is a mix of debt and equity that matters. You can have too much debt and too little debt. Yes, Zach.
I guess the foundation point of understanding Miller, that theory, but it's actually not true. It's just the point of
No, but the trade, it's not the truth if the assumptions don't hold, right? Because if you think about what we started this debt equity trade-off with, is we opened every assumption and said, are there companies that are closer to the Miller Modigliani? Let's take the part of the word where there are no taxes. Middle East? Are there companies there where the government steps in and protects you from bankruptcy? You see, already you're getting, so when a company like that says, how much should you borrow? You're getting no tax benefits from debt. The government bails you out every time you go bankrupt. You say, how much should I borrow? It doesn't really matter. You are actually almost in the Miller Modigliani world. Yeah.
You're saying that firms can be at different positions.
It's a continuum, right? It's not a 0-1, right? The world is a continuum in terms of taxes, not like you have 50% taxes everywhere, zero. The tax rates vary, default risk vary, the amount the government bails you out. Every time you have a bailout of a big company because it's too large to fail, what is the message you sent out to people who borrow money from now on? I'll take away your bankruptcy costs, especially if you're a big company. And then what should we expect? Big companies will borrow too much money, knowing that you'll bail them out. It should be a template that should be in every legislature, right? Because it's not just the action you take, it's the incentives you've created. And this is it's an amazingly powerful way to think about debt and equity because it doesn't bring in any technical stuff, right? It's not betas and cost of debt and cost of equity. It's, hey, think about the trade-off here and think about how you're altering the trade-off. So before we look at ways to quantify the right mix of debt and equity, okay, let's talk about something we observe in practice. Remember, we saw that survey of what CFOs value: flexibility, they want to value survival. So there are actually studies that look at, that ask companies, if you had a choice of where to raise money, which one would you use first? Remember the choice. You can use retained earnings, you can use outside equity, you can borrow money, you can use preferred stock, convertible. There are all these choices. And before you look at what they said, I want you to think about the two things that we saw come out of that process. One is managers value flexibility. They like to be able to get your money and change their mind if need be. And they like control, right? They don't want people looking over their shoulders. If you value flexibility and you value control, of all of the different ways of financing, which one comes with the most flexibility and the least questions asked? Which financing approach? Yeah. Retained earnings, right? The way the world is set up now, people have to beg for dividends. You act like it's your money and you're giving people, you're doing them a favor by paying them dividends. Retained earnings. And in fact, if you look at the surveys that look, most preferred is retained earnings. Now let's look at the second most preferred, and you tell me why this shows up. It's straight debt. As opposed to what? Convertible debt, no special features, just borrow money with an interest rate that's set with finite maturity. Then comes convertible debt. And only then comes new equity. Why do companies prefer new debt over new equity? Because when you have to raise new equity, you have to file a prospectus. The prospectus is specify what you do. It comes with consequences. You have to explain to markets what you're doing. And then you keep going. It's preferred stock. Remember, we talked about preferred stock being this incredibly inefficient way to raise capital. You get the onerous burdens that you get, at least in the US, looks like debt without the tax advantages. And at the bottom of the pile is convertible preferred. Conversion, you're giving away a piece of equity. It's the same reasons you don't like to issue equity, you don't like to issue convertible. That's what the preferences look like. Do they apply for every company? No, but across companies. You know why this matters? What if I could show you, you know what a tombstone ad is? We don't see it as much because we don't read physical papers. A tombstone ad is when a company needs to raise money, it puts in the ad what they're raising, who the investment bankers are, when they're raising it, and they won't tell you why, but kind of, if you get a chance after class, take a look at a recent tombstone ad, because you can, looking at the ad, even if you've never heard of the company, make a guess about what kind of health the company is in by what it's issuing. I mean, let's suppose you open up the newspaper. I've given, I told you that a company is issuing convertible preferred stock. You've never heard of the company. And I say, can you guess how healthy this company is? What's your answer going to be? Yeah. And in fact, here, class example, last year, Bed Bath & Beyond. issues convertible preferred stock. You look at it and say, you guys are scraping the bottom of the barrel. They're not going there because they want to. It's because they've tried everything else and they've gone straight down. This was just before they went bankrupt, incidentally. Convertible preferred is almost the financing of last resort. So if you look at the choices companies make, and that's the previous page, retain earnings, dominant source. Next is debt. Only then comes equity. This goes back and explains what you saw across countries as well. So when you look at financing, managers are driven as much by all the costs and the cost of capital as they are driven by, hey, who do I ever to explain this to? How much control do I have? How much flexibility? So with that lead in, let's talk about specifics. Yes. First, preferred is an awful way of raising money, right? Because you have that dividend, you got to pay it, there's no tax deduction. Convertible, you're giving away a piece of the equity. Why are you doing it? Because the straight preferred, nobody will buy because you're in such trouble. The only way to get people to invest in you. In fact, whenever people offer conversion options, it's because the only way to get people to be involved in your company is to give them a slice of the upside. Right. So whenever you see conversion privileges given, it's because the only thing the company is selling is uncertainty and upside and hoping it pays out as a lower rate. So let's talk about how we can use what we've learned so far in coming up with a mix of debt and equity for your company. Nothing I've said so far is going to help you decide whether you should use 30% debt or 40% debt. It's just a way of thinking about, should I use a lot of debt, not very much debt. So this is the box we're going to be focused on. And I'm going to go through 5 different ways of coming up with that mix. The one that I'm going to spend the most time on should be a familiar concept, the cost of capital. Remember, so far we've used the cost of capital as a hurdle rate in investment analysis. Now I'm going to bring the cost of capital in as an optimizing tool. In fact, the email I sent yesterday, it's a paper. It's not a technical paper. It's a practitioner's paper about cost of capital as a Swiss Army knife of finance. With Swiss Army knives, you can do everything, right? You can carve up meat, you can start a fire, you can open wine, you can fix your house, start a car. I don't know what else you can do, but this is like 15 different things coming out of it. Cost of capital has multiple uses. So I'm going to start with that. That's what I'm going to spend the bulk of time on. It's a very simple extension of what we talked about with cost of capital, but using it to come up with the right mix. A second approach is the cost of capital approach with an enhancement. Basically, I'm going to talk about a limiting assumption the cost of capital approach makes about what happens to your operating cash flows. Relax that assumption, say, how would I use it? The third approach is called the adjusted present value approach. If you run into, either in your summer internships or at your jobs, you run into University of Chicago MBA, they will say the only way to get the optimal debt ratio is APV. They won't even expand it. Sometimes they don't even know how to expand it. You can expand it. It's called the adjusted present value approach. The way it's practiced is absolute bunk. But I'll talk about what you will need to do it right. So maybe if somebody wants to use the APV approach, you can guide them to getting it done right. It's a third way to come up with an optimal mix. The fourth way, and I'd love to tell you this is the exception, is you look at what everybody else in the sector is doing and you try to be as close as you can to them. So you're a software company, nobody else is borrowing money. You don't borrow money either. If you're a telecom company, everybody else borrows a lot of money, you borrow money as well. We'll talk about the psychological reasons why it's so comfortable being close to a peer group average. But if you ask me, how do most companies decide how much to borrow? It's not by optimizing cost of capital, it's by looking at the sector. And the fifth approach is a variant of what I started the class with. You tell me where you are in the life cycle, I'll tell you how much debt to have. So let's start with the cost of capital approach. You shouldn't need reminding since your second quiz was only last week, but I'll remind you again, the cost of capital is a weighted average of your cost of equity and your after-tax cost of debt. As I said, that cost of capital is basically the number we used in investment analysis as a hurdle rate. But the cost of capital has another use, and those of you in both of my classes saw the cost of capital discussion in both my classes, but for different reasons. In this class, it was about finding a hurdle rate, but in my valuation class, it becomes the discount rate used to value the entire business. So let's frame this, right? The cost of capital is the discount rate used to discount the cash flows to the firm to come up with the value of the firm. Let's keep the cash flows to the business the same and change the cost of capital. What happens to my value if I lower my cost of capital? Lower discount rate, higher value. And what's the end game in corporate finance? Maximize value, right? So how would I get there? If my cash flows can be held constant by minimizing my cost of capital. This again isn't rocket science. The lowest cost of capital is not just good in capital budgeting, but it maximizes your value of the firm. So this is easy, right? You just sit there with the cost of equity and cost of debt and just change the debt ratio. If you do that, what are you going to find? If you keep the cost of equity and cost of debt fixed and just change the debt ratio from 0 to 10 to 20% to 30%, what's going to be your optimal debt ratio? 100% debt because cost of it. Yes,
Oh, we not.
that's exactly right. So tell me what's going to change. It's not even technically not true. It's intuitively not true. It's practically not true. So first, what's going to happen to my cost of equity as I borrow more money?
Yeah, get lower and lower.
And your equity earnings get more volatile, right? It's volatility. So you might get more earnings per share, but more, so you have a higher cost of equity. What's the mechanism we use to bring that in? We bring it in through a levered beta. And the cost of debt is the rate at which you can borrow money. You think you can borrow money at the same rate if you quadruple your debt? I don't think so. The lender is going to get more worried. And if you think in terms of bond ratings, the ratings agency is also going to be sitting there watching you. And as you borrow more money, your rating will decrease, your cost of debt will go up. So you're absolutely right. That's what makes this a dynamic process is as I change my debt ratio, the weights change, obviously, on debt and equity, but it's not just the weights. My cost of equity changes because my levered beta changes. And my cost of debt will change because my bond rating will change. Now, there are practical questions you can ask. How am I going to get S&P to give me my bond rating at hypothetical debt ratios? They're never going to do it. We'll talk about how we're going to try to get around it, but the truth will still remain, right? Even if you can't get a rating, borrowing more money will raise your cost of debt. And there might be a tipping point where you might actually lose. What's the biggest benefit of borrowing money? Tax benefit. And if you borrow enough, there might be a tipping point at which even that benefit might hit a ceiling. Because remember, the tax benefit doesn't work with the government mailing you out a check for the tax rate time. You have to have enough taxable income. So you got to constantly keep checking, am I running out of income? Because if you exceed that, then your tax benefit is going to be capped at whatever your income is. Now, do you see why if you ask, if you're asked, when I raise my debt ratio, what will happen to my cost of capital? You kind of, say it'll go down, it'll go up without looking at the numbers. So what I'm going to do for the rest of this class is talk about those. But before I do that, I want to kind of dispel, and this is something I talked about earlier when we talked about cost of equity as well. A mythology that drives the cost of equity and debt can often lead companies to not borrow money. It's actually from a news magazine article of, of an Asian company that did not borrow money. The CFO was asked, why don't you borrow money? And he said, equity is much cheaper than debt. And the way he measured cost of equity is with the dividend yield. And if you define it as dividend yield, what's the cost of equity to Google? 0, right? Equity is free. You see the consequences, right? Not only is this going to mean you're never going to borrow money, you're going to be taking projects that make what return? Greater than 0. It's an incredibly convenient way to take other people's money and do what you want with it. But what am I missing when I look at just the dividend yield as the cost of equity? By now, you already know the answer, but let's fill it in. Why isn't the dividend yield not my cost of equity? If you bought Google shares last week, right? Why are you buying them? Not because you feel sorry for Google, but because you want to make an 8%, 10%, 12% return, right? Where's that return going to come from if they don't pay dividends? The stock price has to go up. The expected price appreciation is in there. So let's get that out of the way. The cost of equity reflects not just dividends plus price appreciation. And that's what we're trying to capture with a levered beta and an expected return in the CAPM. So I'm going to try this, and I'm going to try this on a hypothetical company first, which is kind of a cop-out. But then I'm going to try it on Disney so you can see it play out. This is an example I've saved for 35 years. It's from my first corporate finance class at UCLA. Professor walked in and he said, today we're going to talk about the optimal debt ratio of XYZ widget company. Come on, guys. There are 40,000 real companies out there. Why do we invent widgets? You know why we invent widgets? Because then you have no idea what the company does, right? Have you ever used a widget? I don't know, maybe you can call everything a widget. Is it discretionary? Is it non-discretionary? Is it big? Is it small? Is it tangible? And you can do whatever you want. So already we knew it's going to make up stuff. So he starts presenting this table. He says, it's easy. Here's how you come up with the optimal debt ratio for a company. Put up this table, says debt ratio from 0 to 100%. Already there's a problem. Why can a debt ratio never hit 100%? Somebody has to be left holding the residual risk, right? If you're all debt, you might as well be all equity. Somebody, there has to be at least one guy, one shareholder out there who says, I'll take the remaining risk. So and I'll cut some slack. No, he meant 99.9% debt. He said, as the debt ratio goes up, the cost of equity will go up. And he gave us an intuitive reason. Equity becomes riskier. Equity earnings are more volatile. Guy in the front row, wasn't me, puts up his hand and says, but why is it going up the way it is? Because here's what it looked like it was doing. Going up 0.5%, 0.6%, looked like he basically had made up the numbers. He said, don't worry about the numbers. It's the idea that counts. He says, let's move to the cost of debt. As the debt ratio goes up, the cost of debt will go up. And again, he gave a reason. Bankers get more scared. But then you ask again, why the way it is? And he said, don't worry about the numbers. It's a concept that matters. And then he kept moving on and he said, yeah, but after tax cost of debt, then you compute the cost of capital as a weighted average. And if you notice, the cost of capital decreases to about 40% and then it goes up. The optimal debt ratio for this company is the XYZ widget company is 40% debt. And then he kind of completed the process by actually working out what would happen to the value of a firm, which is easy because you keep the cash flow fixed and you change the cost of capital. The value of the firm increases, the cost of capital decreases. And he was ready to move on and we wouldn't let him. Because you see the problem. This was in every corporate finance textbook. It still is in many books. Basically, a hypothetical company, the debt ratio increases, the cost of equity and debt change. There is a point at which the cost of capital is minimized. If you had this entire table for every company, could you tell me what the optimal debt ratio for a company is? Why would I need you, to be quite honest? I don't even need ChatGPT. This is so stupid. You could ask a 5-year-old, find the lowest number with a couple of candies, you can get there. I mean, you'd have to bribe them to get there. But you don't have this table. Question. Don't use the word strategic. Let's take that out. There's nothing strategic about this, right? This is the most pragmatic of all choices. But why do you throw the word in? You want to borrow even though your cost of capital will go up? Okay. See, this is why we don't want to keep the word. Never borrow for strategic reasons. If you have a good strategic reason, how should you fund it? The strategic is all about things. Remember the option to expand we talked about in China? If that's what's driving you taking a project, use equity, because if good things happen, equity investors benefit from the upside. You'll get much better terms on equity. Borrowing money, the banker is going to look at you and say, I am borrowing for your upside. I'm going to charge you an interest rate and effectively put you out of business and perhaps take your expansion option away from you. Right? When your bankruptcy costs exceed, basically that's what your cost of capital is playing out. The expected bankruptcy cost is exceeding whatever tax benefits are to debt. Remember, that's a trade-off that determines whether the cost of capital goes up or down. Taxes and bankruptcy costs, right? So that's a trade-off that's making your cost of capital. So we gave him so much trouble, he decided we're just dim-witted. He said, you don't get that? Let me show it to you in a different way. He took the numbers he had on the table and he put in a chart and he said, now do you see what the optimal is? It's a low point on the graph. He was completely missing the point. But this is the way I remember my corporate finance book. There'd be nice U-shaped cost of capital. That is the cost. Oh, this is amazing. and then you left the class, you went to a real job, and you said, I'm going to compute the optimal debt ratio for your company. And you went to the CFO and said, can you give me a table of cost of equity and cost of debt at every debt ratio? You know what the CFO is going to say? I have no idea. I have one number. What's the one number you have for your company if you've been keeping up with the project? The existing cost of capital. You don't have a curve, you have a point. So to use this approach, what do I need to do? I need to take that point I have for Disney. I have one debt ratio, 88% equity, 12% debt. The cost of capital is 7.52%. And tell you what the cost of capital will be at 80% equity, 70% equity, 60% equity. Come up with a table very much like the table you see for XYZ widget company. And that's exactly where I'm going. I have zero patience for stuff that works only on paper. For hypothetical companies. We need approaches that work for real companies. So before I start on the table for Disney, let's get the points we know nailed down. First, to get a cost of equity for Disney right now, I started with a beta, right? I start with the regression beta. I said, I'm not using that regression beta, but I start with the beta. If I'd stayed with the regression beta, I'd have got a very different number, but I did use a bottom-up beta. I came up with a cost of equity of 8.52% and a cost of debt of 2.4% at their existing mix of 88% equity, 12% debt. So this is the page you saw before, 7.81% cost of capital. That is their existing cost of capital. So let me frame the question for you. Looking at Disney, the question we're asking is, can changing the mix of debt and equity, right now it's 88% equity, 12% debt, can changing that mix give me a lower cost of capital? That's basically what I want to explore. I don't know the answer before I do that exploration. It might not. But to do that, I need to come up with cost of equity and cost of debt for Disney, not only their existing debt ratio, but every debt ratio from 0 to 90%. So I went back and laid out what I would need to do. Let me start with the easy half. I need a cost of equity, but the way I've structured the cost of equity, where I start with an unlevered beta based on the business you're in and changing it, I can come up with a levered beta at every debt ratio. We already have the tools to do it. For the cost of debt though, do you remember how I got the cost of debt for Disney? I used the actual rating, which was single A. The first time I did this, I had a student at S&P. I mailed him this page and say, I have the rating of the company. And I said, can you please give me what S&P would give us ratings at every debt ratio from 0 to 90%? He emailed back the same page and said, you do it and then we'll tell you. S&P is not in the business of telegraphing what your ratings will be at every debt ratio. That's not their job. But for companies with no ratings though, how did we come up with the cost of debt? We used a synthetic rating. And what drove the synthetic rating? What was the ratio? Interest coverage ratio. The numerator was operating income, earnings before interest and taxes, and the denominator was an interest expense, right? You see the mechanism I'm going to use to come up with the cost of debt at every debt ratio? As you change your dollar debt, you double your debt, what's going to happen to your interest expense? It's going to go up. I'm going to compute an interest coverage ratio, which obviously will go down because your denominator is larger. I'm going to go to that lookup table. I'm going to come up with a synthetic rating at 20%. And once I do that, I've got a cost of debt. Then I'm going to have a table that looks exactly like XYZ widget company, but this time for Disney. And this time I will have an answer when you say, why is my cost of equity changing the way it is? So before I get ambitious, I said, let me go back and get those base numbers nailed down. To do this, I need an unlevered beta. There are two ways I can get an unlevered beta. One is I can trust the regression. Remember, I had a regression beta for Disney and unlever it using the average debt to equity ratio over the last 5 years. The second, and this is the approach I went with because I said we want the law of large numbers, is to break, this is exactly the same table that I used before, but now I'm using it as my starting point for my optimal financing mix. It's a weighted average of the 5 businesses there. So I know what my unlevered beta is. I'm going to go with the unlevered beta of 0.9239 as my starting point. So already we know one cost of capital, right? What's the one cost of capital? You can already tell me that's different from the current cost of capital that you don't have to do very many calculations. When can I use the cost of equity as my cost of capital? With zero debt, right? There's the unlevered beta. You're done, right? You take the risk-free rate plus the unlevered beta. So You have 2 points now. You have a 0 debt ratio. We're making progress, 0 and 80. But when I borrow money, what's going to determine how much I can borrow? What's in the numerator is going to drive my interest coverage ratio. So to give you a sense of what that EBIT is, how much earnings I have to be able to service debt, I computed what Disney's operating income was in 2012. And already you can see if you're borrowing money, maybe I don't want to use 1 year, you can have. So there's nothing that says it has to be last year's number. Here I've used last year's number just to illustrate. I could have used an average number over the last 5 years. Why? Because if I'm borrowing money, I don't want to borrow on a really good year. If you're NVIDIA, you don't want to borrow money based on 2023 as your base year, because then you're assuming every year is going to be great. But at least in 2012, their operating income that they had available to service interest expenses was 10.03 billion. When I did this, remember, accountants were not capitalizing leases, so I did that to clean up the operating income. So I know what the unlevered beta is. I know how much earnings they have to service that. I'm ready to launch. So let's start with the easy half of the equation. If I have an unlevered beta and I have a tax rate, can I estimate the beta at every debt to equity ratio? Of course, right? It's just a mechanical device of calculating. So here's what I have. At a 0% debt ratio, my levered beta is my unlevered beta. And at every debt ratio beyond that, my levered beta is going to go up because, I have more debt, a higher debt to equity ratio, a higher levered beta. In the last column, I've computed my cost of equity. Risk-free rate remains the risk-free rate. Whether I borrow money or not, that doesn't change. And the equity risk premium has nothing to do with my company. So the 5.76% carries, but my cost of equity for Disney will go from 8% to 38% as I go from 0% debt to 90% debt. I stopped at 90. I didn't see the point of going to 99% debt. Everybody clear on the mechanics here? So this is just an extension of what we did on quiz 1 and maybe even on parts of quiz 2, but basically taking the unlevered beta and levering it up. And already you can see why I so quickly buried regression betas as soon as we saw them, because the only way you can get the beta for your company is run a regression and stay with that regression beta. This table is going to be impossible to do, right? You have one beta for your company, it never changes. Question? Go ahead, Zach.
So is the difference really the only step between what we had studied for the quiz and this?
There's no difference at all. This is exactly, we're using that process now, but we're being dynamic. We say, it's not just the existing debt ratio, let's look at every conceivable debt ratio. Okay? Now, the cost of debt is a bit of a mess. And I'll go through the process and you can tell me where the mess comes in. What do I need to come up with the rating? I need an interest coverage ratio, right? I'll take the step from 0 to 10%, and then I'll show you the 10 to 20 and 30, because I'm going to do it by hand. You're saying, as opposed to what? The Excel spreadsheet that does this for you does it itself, but it looks like a black box. You say, that's magical. There's nothing magical about it. I'll take you by hand through the process. What's my objective? I want to figure out what Disney's cost of debt will be at a 10% debt ratio. Remember, I don't have that yet. I have a debt ratio at what they have, actually. So to get the debt ratio at 10%, here's what I start with. I start with how much dollar debt I will need to get to a 10% debt ratio. Do you know why I need the dollar debt? I need interest expenses. To get interest expenses, I need to know how much debt you will have. Now, how do I get the dollar debt? This, remember, everything we do is in terms of the market value, the value of the entire business in the market today. So I start with that. I take the market cap, which is 121.878 billion. I take the market value of debt. Remember, I use the leases and the market value. I add them up. The total value for Disney as a company is $138 billion. And if I want to get to 10% of that, I need to borrow 10%. So again, all I'm doing is taking 10% of the value of the firm, which I can observe and say, if I went to a 10% debt ratio, that's how much debt I will have. 13,784 million. Everybody with me so far? So if I went to a 20% debt ratio, that number will become 568. And so each debt ratio, I can compute how much dollar debt I have. Justin? But remember, once I come up with that value, that is the value of the business. So I'm trying to start with that. Yes. We'll hold off on that because we haven't got to the circularity yet. Right now, I don't have a circularity issue, but you can tell me at the step at which you have the issue. So I've got the dollar debt. Yeah. I just took the market cap of the firm, share price times number of shares, and the market value of debt. So those are the numbers I used to come up with the original debt to capital ratio. So you add those two numbers up, that is the market value of the entire business. Then I need to get to EBIT, right? I know the EBITDA, the interest, EBITDA, the depreciation, the EBIT right now. Question. That's the market value of my debt, right? So basically it's lease debt plus the market value of interest-bearing debt. No, it's just interest-bearing debt and leases, okay? It's exactly the same debt we used when we computed the debt ratio originally for Disney.
Isn't this because the financial statements now do account for debt or leases as debt? Do we still need to?
You don't need to do it yourself then. It should already be lease debt on your balance sheet. You can just take the debt. So whatever debt you use in your cost of capital calculation in part 3 of your project to get a cost of capital now returns to the analysis to come up with the starting value of the firm. So then I want EBITDA, depreciation, and EBIT, which I know right now. And I borrow all this money and it stays exactly the same. That's weird, right? If I borrowed 13.8 billion, you're saying, where's the money going? Whenever you are looking for an optimal debt ratio, the way you do it is by doing what's called a recapitalization. So what you're effectively doing is leaving the assets out of the balance sheet fixed. And when you borrow money, you know where that money goes? To reduce equity. You buy back stock, you pay a dividend. It's your only way to keep your focus on the financing mix. Because if I take that money and invest it, two things are going on, right? I've changed the debt ratio, I've taken new projects. God only knows what the net effect is. To isolate the financing effect, whenever you optimize debt ratio, you do a recapitalization. You change the mix of debt and equity in the company. That's why the EBITDA, the DA, and the EBIT remain the same. Now comes the part where I have an issue, and you'll see what the issue is. How do I get interest expenses? I take the interest rate and I multiply it by the dollar debt, right? I know the dollar debt, but I don't yet know the interest rate that I will have at 10% debt. So I cheat, at least for the first round. I cheat by doing what? By taking the interest rate I used to have when I had no debt. When I have no debt, I'm AAA rated. I take that AAA rate, multiply it by the 13,784. I come up with an interest expense of 434 million. EBIT divided by interest expense gives me an interest coverage ratio of 23.1. I very gingerly turn to the next page and say, what rating will I have? 23.4. I'm way above the top there. It's AAA rating. I heave a sigh of relief. Why do I heave a sigh of relief? Because the rating I used to come up with the interest rate happens to be the same as the rating I ended up with. I am done. I have a 10% debt ratio. Yeah. Oh, you can do whatever you want with that. It's not going to happen accidentally. I deliberately do it because I take that debt I used to buy back stock. That cash is now gone. I can't invest it as well. So it's by doing that, I've removed the effect on operating income. Is the cash comes in, it goes, so it comes in through one window, the debt window, it goes out through the equity window. It will not affect the operations. You're saying, will this always happen? I wish. So I'm going to take you through the 20% debt ratio. Actually, the 30% debt ratio, so you can see when this is going to give you some heartache. So I did the 20, now I'm trying to get to 30% debt ratio. At 30% debt, the dollar debt I will need is 41,352. That's 30% of 137 million. So basically each round I'm adding 13.7 billion to my debt. Everybody with me so far? At a 30% debt, my debt to equity ratio is 30/70. So that's just for mechanics. I'm setting that to the side. The EBITDA, the DA, and the EBIT don't change. Why? Because I'm still playing the same game. Debt comes in, leaves. For the interest expense, I use the rate I had at 20% debt, which was AAA. I come up with an interest expense of 1.3 billion. So I'm still using the AAA rate. So don't look below that because when I'm doing this, I don't have the interest rate yet. I compute the interest coverage ratio of 7.7. EBIT, 10,032 by 1302. I go back to the previous page and we have a problem. Do you see what the problem is? At a 7.7 interest coverage ratio, what should my rating be? It should be AA. And at a AA rating, my interest rate should be 3.45%. The problem is I computed the interest expense with a 3.15% rate, but now my own calculation tells me I should be using a 3.45% rate. Not fatal, right? Can I fix the problem? What do I need to do to fix the problem? Recompute the interest expense at a 3.45% rate, which makes the interest expense go up, the coverage ratio go down, and now I'm really terrified to go back to the previous page because what might have happened? I could have slipped another notch. Thank God that didn't happen. I'm still AA. I'm done with 30%. You give me a sheet of paper, an abacus or a calculator, and I can compute the cost of debt for a firm from 0 to 90%. Probably it doesn't. I mean, this isn't nothing you're doing is, it's not stochastic calculus. It's add, subtract, divide, multiply, go back to the table, get a cost of debt at everything. That's effectively how I got the cost of debt at every debt ratio. And that's what your Excel spreadsheet will do. The circularity here comes from the fact that the interest rate used affects the interest expense, but the interest expense affects the interest rate. So how do you think I got around that in the Excel spreadsheet? First, there is a box you might have never seen. There are mysteries to Excel I've never explored. I don't want to explore. There are these layers and layers of things. There is actually a very useful feature in Excel under the calculation options, where there's a box called the iteration box. The default is set to 100 iterations. You check that box, you know what Excel does? When it runs this problem, it does what I did manually. I did it twice. It does it 100 times. If that doesn't leave you comfortable, you can change to 1,000, 10,000. It doesn't take Excel that much time anyway, but it's overkill. Usually it's never taken me more than 3 or 4 times by hand to get it to converge. Excel goes 100 times on each debt ratio. And here's what it came back with as my cost of debt at every, so this is the final iteration for every debt ratio. So let's go through what happens. As my debt ratio goes from 0 to 90%, my dollar debt climbs from 0 to 16.4, I'm sorry, my dollar debt climbs to 124 billion. You know why it's 124 billion, right? 90% of 137. So when you think about debt ratios, you're talking about market value. You know what a 50% debt ratio for NVIDIA would look like right now? $1 trillion in debt. Can NVIDIA afford it? No, nobody can afford $1 trillion in debt. So be careful about ratios saying that looks low because it depends on what the market value of your company is. As my dollar debt goes up, my interest expense goes up more than proportionately. Let me repeat that again. As my debt ratio goes up, my interest expense will go up more than proportionately. Why? Because my interest rate changes, right? As I borrow money, the interest rate changes. As my interest expense goes up, my interest coverage ratio obviously goes down. It starts at 23.1. By the time I'm get to 90%, my interest expense is actually higher than my EBIT. As my interest coverage ratio goes down, my synthetic rating, which started at AAA, starts off, goes to AA, single A. Before you know it, it's in triple C, single C territory. So can Disney be any company can be a double C rated company if it wants to be. You borrow enough money, you're going to get there, right? Doesn't matter how great your company is. And as my rating goes down, my cost of debt climbs. It's not a difficult approach. It's actually taking what we've already used and using it as a building block. Which then brings me to the second to last column where the margin, the 36.1% was the marginal tax rate. That's what we used. But something seems to happen at 80% debt, where I'm actually at 70% debt, where my marginal tax rate goes down. First, is that a good thing or a bad thing in a cost to capital context for tax rate to go down? What happens when your tax rate goes down, your after-tax cost of debt goes up, right? So what do you think is happening at 70% debt? Yes. Running out of earnings. In fact, the clue is look at this ratio, right? Drops below 1. My interest expense is now higher than my EBIT. In fact, I'll take you through the mechanics of how I come up with the tax rate. Remember, the maximum tax benefit you can get is to get interest expenses all the way up to EBIT. The EBIT here was 10,032 million. So if 10,032 million interest expenses, I have capped out my tax benefit. That tax benefit is 3.622 billion. At the 70% debt ratio, my debt actually becomes 11.1 billion. And if you take 11.1 billion, you divide the maximum tax benefit you get by the 11.0, the tax rate you're going to end up with is 32.64%. If I go to 80% debt, remember my maximum tax benefit doesn't change. I've already capped it. You're going to see the marginal tax rate decrease. That pushes up the cost of debt as you get to higher and higher debt ratios. You don't want to be there. But you can explore what will happen, right? 78. One of the things that always troubles me about LBOs is people borrow money that actually increases the interest expense above the tax benefit, but they still continue to use the marginal tax rate that they used to use before that. This isn't magic. This isn't a one-time deal. You created a permanent problem. Remember XYZ Widget Company? This is my Disney variant on that, where I have the debt ratio of 0 to 90%. Beta is going up, cost of equity increasing, cost of debt increasing. Why? First, because my rating is decreasing, and at the very high debt ratios, because my tax benefits are going away. In the last column, I have my cost of capital. What's my objective? When I want to maximize my value as a firm, minimize my cost of capital. Where is that going to happen? Well, 40%, 7.16%. It's a little unfortunate. We've had 2 examples in a row with a 40% optimal. I remember I was doing this at an investment bank. I won't name the bank. And it was a re-education camp for senior bankers who dealt a lot with debt. None of them wanted to be there. And one of them in particular wanted to show me how much he did not want to be there. So it was a day-long session. He sat in the back row reading the Wall Street Journal. He kept reading the same page. I kept saying, like, please turn the page, And then you get to this stage, he puts up his hand. I'm surprised the guy's not even been listening. So he must have, maybe he's a savant. He can listen and read at the same time. He says, can we safely assume that the optimal debt ratio for every company is 40%? I said, you can safely assume whatever you want, and I will safely assume you will not have a job in a couple of years. It turned out that my assumption was better than his. But it's amazing. People walk around, isn't the optimal debt ratio for every company? How do you make up crap like this? You're each going to compute the optimal debt ratio. I'll help you out. The Excel spreadsheet. That's why I said the bulk of the work on this project is coming up with the cost of capital. I will do your optimal debt ratio for you because you've already collected all the information you need to do the optimal. And I'll make a prediction. There are 200 companies in this class. There will be some of you for whom the optimal debt ratio is going to be 0%. Now, I ruled out money losing. If you had money losing companies, those companies would definitely, but even money making companies, if you're not making enough money and your market cap is huge, you can see very quickly, even getting to a 10% debt ratio is going to tip you over the edge. And there are going to be companies in this class where the optimal debt ratio is going to be 60 or 70% or even 80%. We'll talk about what causes the optimals to vary. Question? Okay, go ahead. Please don't use that word on me. Right? Use it in another class. Yeah. Yeah. Yeah.
On the balance sheet, you don't write it as debt, you write it as like management costs.
So you're going to hide the debt and not expect it to catch up with you? That's what Enron tried. No. The reason, no, there are companies that actually do it. She's actually on to a point, which is companies think that if they take the debt off the balance sheet, they hide it in a special purpose entity. It's like the tree falls in a forest and nobody sees it fall. If you borrow money and nobody knows you borrowed money, have you borrowed money? Yeah. Okay.
That's something you need to pay, right? You need to pay the.
Yeah.
So instead of writing that as a debt, you write it as cost. So
Don't you pay costs? Costs are outflows as well, right? Writing something doesn't make it go away, right? But it reduces your earnings. What's in your numerator? Your operating income, right? So when you write something as an expense, what do you do to your operating income? One way or the other, I'm going to get you, right? No, so you can either put in the denominator, you have to spend money, you got to spend money. Don't go there. That way is also the way to jail eventually. So this is not a pathway you're going to be exploring, because the truth is you borrowed too much money. I don't care what you call it or how you account for it. Of course, you have lower earnings, your rating is going to go down, right? It might have an even bigger effect because all your existing debt might have to go up. So if you want to call it strategic, I'm willing to go along because it kind of feeds into my version of strategic. But if you're borrowing too much money, there's no easy way to hide it. Okay. We'll talk about what causes optimals to vary. But I did take that cost to capital approach at the XYZ widget company. I tried it for to Disney. And this is what a true cost to capital for a company looks like. And it's not a U. In textbooks, it's always this nice U shape. First, there is benefit from debt, right? But it's mild. Your cost of capital is not going to go from 8% to 6% when you borrow money. It's going to go from 8 to 7.5%. I'm not saying that we'll talk about how much of an effect that has on value. And take a look at what happens when you start to borrow too much money. It's not any gradual increase. It just implodes on you. There's an inflection point for debt. You hit that inflection point, things start to blow up on you, which already tells you if you're going to make a mistake on debt, should you be under levered or over levered? Better to be under levered than over levered. Keep that in mind when you make a judgment for your company. Come up with an optimal of 30%. There's nothing in corporate finance that says you have to go to 30. You might say, I'm going to go to 20 and stop because. Now I'm in a risky business, things can change. You want to stay away from those inflection points. This is the 4th edition of the book. Oh, go ahead. It's that, and things start to, remember that interest coverage ratio, it starts to go into high motion. You start to change and you start to get lower and lower levels. Small changes can tip you from, single A, triple B. So it's before you know it, you say that's only a 1 notch, it becomes 5 notches. You want to get away from that notching down, because once it starts, you just kind of go into, because each time it notches down, it makes your problem even worse, right? It feeds on itself. The 4th edition of the book, you don't have the book, but I didn't ask you to buy the book, but this is the lecture notes come from the 4th edition of the book. Disney's been in every edition. This is the 1997 edition. So if you ask me, what do you think that's new in cost of capital? I think exactly the same way about cost of capital now as I did in 1997. And this is what the graph looked like then. Now, this Excel spreadsheet that I'm going to send you as a link that you're going to use to compute the optimal debt ratio for your company has been on my website now for more than 30 years. Almost, I don't know how long websites have been around. As long as my website has been around, it's been there. And for a while in the 1990s, the early part of the century, there were people at what was then the First Chicago, which is an investment bank. It's now part of JP Morgan. It's where Jamie Dimon actually came from, First Chicago. Bankers there were downloading the spreadsheet and using it to come up with optimal debt ratios for their clients. Word got back to me, but I said, oh, it's fine. It's open source. They can do whatever they want. So I'm sitting in my office. I get a call from a First Chicago banker. He says, I'm calling from a restroom. I said, why are you calling from a restroom? He says, I've had a very embarrassing moment with a client. And I said, just call your mother. And he says, no, not that kind of embarrassing. I was using a spreadsheet to do an optimal debt ratio, and I put up the graph, and there's a kink in your cost of capital. Like that. He says, what's wrong with your spreadsheet? It takes a lot of gumption to download a spreadsheet for free, use it for commercial purposes, then turn around and call me and say, what's wrong with your spreadsheet? So, and I should have asked him, what's your social security number? Can you give me a bank account number, wiring information? But you could probably tell him what it is about the process we're using that's causing this kick. I'll give you a clue. It's got to be something moving discontinuously. Yeah. Yeah, remember the levered beta, small changes, my cost of equity changes. But when does my cost of debt change? Only when my bond rating changes, which happens only when I go to the next level of the table, right? In the real world, that's not the way the world works. I could be a low triple B rated and a high triple B rated, and my rates would be different. But because I did not build it in, you got the benefit of borrowing money without a rating change, at least for that debt ratio. Guess what happens? When I go to the next debt ratio, it catches up with you and you get a much bigger change. So I took him through the process and said, that's what's happening. Yes. You're not going to use it strategically on me again, right? Okay, go ahead. Yeah. But even if you make 10 small changes, the amount to the large change, you'll have exactly the same effect, right? Because you're moving just inch by inch to it. It's not the all at once that matters, right? Because in the real world, even though your rating doesn't change, your rate will change. Markets discriminate between high triple Bs and low triple Bs. I'm not allowing for that because I have one default, one spread. Yeah, because I can't do that in the sheet, right? Because for convenience, I've said this is the most common spread for a triple B rated company. There's a range. No, it won't stay the same. There's range means it'll change gradually, but it'll never stay the same. So basically, within that range, the cost of debt will actually be different for triple B rated bonds. I haven't built that in. Right? Yes.
That debt and they, have AAA bonds out on the market trading, and they do want to move to that 40%. And when they do that, they're gonna get re-rated at.
Exactly, and all the AAA rated bonds will now get knocked down in value. In fact, when I do this, I'm implicitly assuming that you can't rip off your existing bondholders, that everybody now gets re-rated and gets a higher interest rate. We'll talk about a way in which you can rip them off, because remember, that's what Nabisco did, right? There's a wealth transfer. I'm not even including that because to me, I want to get the optimal debt ratio without ripping off your bondholders. But think of that as icing on the cake if you can pull it off. Yes. Doesn't matter. That choice I will leave to you. So if you want to take the debt and make it convertible debt, then basically some of it is equity. So ultimately, the dollar debt here is the debt portion of whatever debt you've chosen to use. It might, but remember then you're using less debt as well, right? Because if you think about a convertible bond, the whole bond is not debt. A portion of it is equity. I know the accountants treated it all as debt, but in the corporate finance world, so I could issue a convertible debt that's almost all conversion option and very little debt. And I will act like you haven't borrowed much money, which is the reason very young companies say they're borrowing money, but you look at their convertible bonds, it's almost like a warrant with a tiny bond attached to it. I would look at only the debt portion of the convertible debt. Yeah, it's easy to strip it out. Just take out the conversion option because that's really the debt that matters. So I told him that this is what's happening. And he said, can I make it go away? I said, yes. One is you close one eye and not look at the kink, But I said, there's a way you can make it go away. What's causing this? Discontinuous changes. What if I created remember, these are synthetic ratings. What if I created that synthetic rating table with AA+++? In other words, I make the ratings finer and finer. I'll effectively make the kink go away. So I said, you can do that. He said, that sounds like a lot of work. I said, there's another way you can do it. Why do I need a rating? Because I want to convert. Can I skip the rating entirely? What if I tied the interest coverage ratio to your default spread directly? Right? Because all I need is the ultimately cost of debt. To me, a rating is just an intermediate stop. I can make it continuous. He said, that sounds too complicated. I said, I can't help you. The approach is, you can make it as malleable as you want, but ultimately that's what's going to constrain you. So let's summarize what we've discovered, and we'll come back with this as a starting point. Disney right now has $16 billion in debt, at the 15.96 you saw me start. Based on my analysis, they should be at a 40% debt ratio, which is $39 billion. So what do I want them to do? Borrow about $23 billion in new debt. I'm not done though. What do I want them to do with the debt? They have to buy back stock or pay a special dividend. It's got to go to the equity investors. Is that a big transaction? It's huge. And if you are Disney's board, given the board now, I don't know whether this is the way I should state it. If you are a prudent board at Disney and you were asking questions, there should be at least 3 questions you need to, and these are generic questions you'd always ask when somebody says you can borrow more. First is, what if, why should we do it? And you say the answer is easy. Your cost of capital will go down. Your cost of capital will go from 7.81% to, let's see what it goes down to, 7.16%, 65 basis points. I want you to borrow 23 billion, buy back stock, low. So first I've got to convert that cost of capital change into meaningful numbers. This is what it means to your stockholders if you do it. Why should we do it? What if something goes wrong? You know the answer I should never give if I'm the one advising you to borrow money? Oh, nothing will go wrong. This is like tempting the gods while you're standing there. Of course things can go wrong. I mean, COVID could hit 3 months after you borrow the money, right? Question?
Nothing goes wrong, this falls, there could be the impreciseness with the number.
There could be what?
Imprecision. Not enough.
No, but remember, if something goes wrong, the numbers were not wrong. They reflected what I thought would happen, but the world can deliver surprises. That's why I use the COVID example. Now, nobody saw COVID coming. It hit you. And then because you'd borrowed all the way up to the hilt, all of a sudden you were in trouble. Justin. It's because both reduce equity. It has to be a special dividend, right? So you pay $15. It's very much, the only difference between a buyback and a special dividend is the buyback is selective. Only the people selling their shares get the cash. With the special dividend, everybody gets the cash. And finally, there's a question that I think is worth asking. In this case, what did I force you to do with the additional debt? Buy back stock, right? Disney has all these big plans in 2013, building a new theme park, making, expanding Avengers. Disney Plus was just a glimmer in their eye. But what if they wanted to invest that money? It seems like a waste to pay it out and then raise capital again. So the final question is, will the optimal debt ratio be the same if instead of buying back the stock, we decided to expand the business? So those are the 3 questions we will start with next session. But in the process, we're also going to look at why optimal debt ratios will be different across companies. You want what would really help in that discussion, and you can jump ahead, is you can do the optimal debt ratio of your company, even if you haven't done the first 5 parts. I'll send the story of the little red hen for you as kind of a parable to read. But bring it to class with you if you can run it before Wednesday and tell me what your optimal is. We can talk about why optimals vary across companies. So I'll see you on Wednesday. Yeah.